In my experience, payroll is one of the most complicated, if not the most complicated area of accounting, or at least bookkeeping for a company. And one of the main reasons for this is payroll deductions and payroll liabilities. You see, employees do not receive their gross paycheck. They receive a net amount. And that's not a newsflash to anyone watching this video who has ever earned money as a W-2 employee. You know that you don't get your full pay amount because there are deductions that are taken from your paycheck. Could be federal income tax. For most people, that's probably the case. There's also Social Security tax and Medicare tax that come out. Those are, again, federal liabilities. If your state imposes an income tax, most states have some sort of an income tax, that is also potentially withheld from your paycheck. Perhaps you live in a city that imposes an income tax, or if you're like me, I don't live within a city that imposes an income tax, but I'm currently recording this video inside the city limits of Grand Rapids, Michigan, and they impose an income tax on non-residents who work in the city. So even though I don't live within the city of Grand Rapids city limits, I have city income tax withheld from my university paycheck. And there may be other deductions that come out of an employee's paycheck. A lot of times these are voluntary, like insurance or retirement plans or union dues. And these are just a few examples. You could give to the United Way or another charity and your employer withholds that from your paycheck. So what we're seeing here is when the employer withholds these amounts from the employees and the employees receive a lower paycheck than their gross amount, it doesn't mean that the employer gets to hold on to that cash. That wouldn't be a very good situation. What happens is, take these three for example. These amounts right here are current liabilities to the United States Treasury. So even though the employer withholds these amounts from employees' paychecks, it's a very short time where the employer withholds these dollar amounts. Within the next week, or at least maybe several weeks, it depends upon the magnitude of the withholding, how big of an employer you are. But just know this, in the very near future, the employer needs to take these withheld funds and remit them to the United States Treasury. Then we have here, okay, this is going to go to state of whatever. If you live where I live, that's going to the Michigan Treasury. This is obviously going to be due to whatever city was applicable for the withholding. And then these right down here, these could be and would be a various number of payees. Union dues would go to the local union if that were applicable. Health insurance premiums over to the health insurance company. Retirement plan contributions go over to the retirement plan provider, etc., etc. These amounts withheld from employees' paychecks will be a current liability on the employer's balance sheet. This is an example of one employee's individual pay record. It probably looks familiar to you if you've ever had a job and you received a pay stub. As you can see, his earnings are up here, both the current pay period and year to date. And you can see that he earned, for this current pay period, just over $395. But we know that's not the net amount that he's going to receive, right? Because taxes were withheld right here, okay? Those taxes being federal withholding. So that's a withholding that will give this employee credit toward his federal income tax liability for the year. State of Michigan income tax, similar to the federal withholding, the state of Michigan income tax withheld, that will be reported on the employee's W-2, and then he'll be able to take credit for that when he files his income tax return with the state of Michigan. Then we have FICA and MedFICA, and you're maybe saying, well, what is that? I know there was a Social Security you talked about. I know there was a Medicare that we talked about, and that's really what these two things are here. Now, the payroll company that prepared this particular pay stub, they choose to abbreviate Social Security as FICA and Medicare as MedFICA. And the reason they do that is really both of these taxes were authorized under a federal act called the Federal Insurance Contributions Act. And what it really means then is that the employee, 6.2% of their compensation is going to be withheld as the employee's share of Social Security. Now this 6.2%, it's only on a certain limit of compensation that the employee earns. For 2019, that's just over $130,000, $132,000 to be more precise. So in other words, if the employee earns less than $132,000 during 2019, the entire compensation would be subject to this 6.2% tax. If that employee earns more than the threshold, which is $132,000 for the current year, then only the first $132,000 would be subject to the tax. Any earnings above that would not be subject to the Social Security tax. That threshold, by the way, gets indexed for inflation, and it changes almost every year, and it goes up. Okay, so that's a number that's not static. Now, Medicare tax, that's 1.45% of the employee's earnings, and that is on an unlimited amount of earnings. Okay, you could earn, your name could be Bill Gates, it could be Steph Curry, and you would be subject to Medicare tax on all these earnings. Okay, that's why we're doing that. The payroll company just chooses these particular captions. And that brings me to a note about payroll companies. I highly recommend using a payroll service. I own a couple of businesses, and I don't prepare my own payroll because the cost of hiring a payroll service is well worth the effort that you save and the time that you save, because the payroll service will handle all of the employee paychecks and direct deposits. They handle all of your payroll tax remittances to the various state, local, federal governments. They will file your quarterly and annual payroll tax returns. They even prepare the W-2s for the employees at the end of the year. I think it's well worthwhile to use a payroll service. And I don't get a commission because you notice I didn't recommend any particular payroll service. Now, there's one other deduction I want to point out here. This one isn't really voluntary, but it's not a tax. Notice it says child SU. Well, I'm guessing that the payroll company only has so many characters available for a deduction field. This is child support. So sometimes what will happen is if the state mandates that, or whatever governmental entity is appropriate to your jurisdiction, but basically the state or the government mandates that the employer withholds money from an employee's paycheck for support of children that don't necessarily live with that person. So in this case, we do have an unmarried man, and he has a child, and this employer is required to withhold money from his paycheck and then remit that over to the state of Michigan for his child support. So that's another deduction. As you can see, if we take a look at this, his gross pay was $395 and a penny. And then we had those federal, state, and federal income tax, state income tax, and the Social Security Medicare tax. And then we have the child support that's coming in here. And his net paycheck is much smaller than probably what he would prefer, but it's the reality of the payroll system here. So this was his gross pay after deductions. This right here is his net pay. This dollar amount right here is what the employer will pay to the employee for this particular payroll. And then these amounts right here become current liabilities on the company's balance sheet. And those will be remitted to the federal and state government and to the state agency that handles child support payments in the very near future. That was just one employee's pay record. This is a summary for the entire company for that particular pay period. And I know there's a lot of stuff showing up here. Well, the company has different earnings categories. For example, regular wages, and here are the hours. Salaried employees, that's 80 hours. Bonuses, somebody gets a shift manager premium, for example. And so what we're basically seeing is that this company needs to have these various captions or pay categories for keeping track of different pay rates for different functions performed. But at the end of the day, if we're going to record this payroll, this is one of the numbers that we really just care about, because that's the salaries and wages expense. So let's go over here. It's going to be a little tight, but we're going to construct some journal entries here. Salaries and wages expense, that's the easy part of this journal entry. And we're going to debit that for $27,188.15. We know that expenses are increased with debit entries, so that's what we're doing here. But as we're going to see in a second here, in fact, I'll just do this. The cash credit is only going to be $21,320. I'm going to put this over here. This $21,320, and a little bit of change over there. Might as well put dollar signs on everything. So you guys know that if you're taking a look at this mega journal entry I have here, that the debits do not equal the credits. And here's the reason. Remember those payroll deductions, the amounts that we withheld from employees' paychecks? Well, those, as promised, become current liabilities. So let's take a look at federal income tax withholding payable. That is an amount that is due to the United States Treasury. And we should be able to go over here and find it, the employee taxes and deductions. It is, if we find federal withholding, right here. So we know that in aggregate, in total, that's how much we withheld from employees' paychecks for federal withholding. Dump that over here as a credit. Okay. $2,488.27. Same is going to be true for Michigan withholding payable right there. Okay, so I'm going to call it Michigan income tax withholding payable, and that's $1,100 and some change. Then we have Social Security Medicare payable. So we've got really these two amounts right here. I did not do a very good job of circling them, but I think you guys understand what's happening with that. And that actually totals up, if you add those two together, $2,079 and a few pennies. And remember our friend's child support payment. That's the last current liability right here, the $194. And that happens to actually, if we go back here, that happens to actually match what was on the employee's pay stub, because he is the only employee at this company with child support. So here's our last current liability, child support payable, which is going to be the $194.44. And now we have a journal entry that records the entire company's payroll. A little bit of a gap here because I started with the cash, but I think you guys can still work with that. If you do the math, you will see that the total of these credits is $27,188.15. Total of debits is $27,188. What we've effectively done here is we've recorded the payroll expense on our income statement. We've recorded the cash payments to our employees. If you added up every direct deposit for this employee, for the employees for this payroll, it would total up to this amount. And then we've recorded current liabilities, 4 individual current liabilities payable to the United States Treasury, the Michigan Department of Treasury, United States Treasury once again, and the state agency that oversees child support. Do you remember when I said that payroll is arguably the most complicated bookkeeping that a company could encounter? You may have started to agree with me when you looked at all those employee deductions. But I got to tell you, that's only half the story. Because in addition to the employee taxes and deductions, which I have reprised right here for this particular payroll we're looking at, there's also a number of employer taxes that get added on. Take a look at this. So you see something here that says company FICA, $1,685. Notice that, now that's the company's portion. Notice that over here, FICA for the employee, $1,685. And the same is true for Medicare. The company has a portion, the employee has a portion. Because you remember when I told you that Social Security is 6.2% of an employee's compensation up to an inflation-adjusted limit Right now for 2019, it's 132, almost 133,000. And that'll be a different number for 2020 or whenever you watch this video. But that gets taken out of the employee's check. And then Medicare, I had told you, was 1.45%. So the math's not particularly difficult. For somebody that earns less than $130-some thousand under current law, they're going to have 7.65% taken out of their paycheck for combined Social Security and Medicare. What most people don't realize, and this is really a bit of a stealth tax because it happens behind the scenes. Employers know about it because if they don't pay this tax, they will get love letters from the IRS, and it's not the kind of love letters that employers want to receive. So employers know about it, but most employees don't, in my experience. Okay, so what happens is this gets doubled. And what the employer ultimately ends up remitting to the U.S. Treasury is closer to 15% of compensation. Because you see, when the employer withholds these amounts for Social Security and Medicare from your paycheck, they have to match it right here. That becomes an additional payroll expense for the employer. And then they send the doubled amount to the U.S. Treasury. So what you're seeing here is that, and I've erased things to give us some room here, but we have the Social Security and Medicare match that the employer is going to remit to the U.S. Treasury. But then we also have a couple of unemployment taxes. Unemployment taxes are only paid by the employer. And what we're seeing here, this is FUTA, is the Federal Unemployment Tax Act. So that's a federal tax. And then there's a state level tax as well. In this case, this particular company puts it into two categories because they have a kind of a baseline unemployment to the state of Michigan, and then they have something called an obligation assessment. That's what this MIER is. It's an additional unemployment tax. But what I want you to know is if you ever see unemployment taxes withheld from your paycheck, you should become a whistleblower because that's not right. The unemployment taxes are borne only by the employer. Okay, these are employer taxes. This is how the unemployment fund gets funded. If you get laid off from your job and you claim unemployment, there is a pool of dollars available to give you some level of compensation. Well, that money has to come from somewhere, and where it comes from is the unemployment taxes. The lion's share of unemployment taxes for most companies is paid to the state. As you can see right here, for this particular company, we've got $12 for the base tax, and we've got $71 for the obligation assessment. And so for this particular employer, paying just shy of $83 to the state government versus $41 over here to the federal government. Let's take a look at how this plays out in the company's books. The total here of employer payroll taxes is $2,200. So that's an additional expense for the employer. So I'm going to call it payroll tax expense for lack of a better term. Sometimes companies might choose to have individual expense items on their books for each one of these taxes, and that's fine. There's no particular rule about that. It's whatever's useful for the company for bookkeeping. And then what we're going to see here is that some of this Social Security and Medicare tax payable, that is going to be the same amount that was withheld from the employees' paychecks. This right here, this journal entry, this portion of the journal entry that we're making right now, this is the employer match. This is the doubling. And then we have unemployment, FUTA tax payable. This amount is due to the federal government to partially fund the unemployment system. And as I mentioned, the lion's share, or usually a much larger amount, goes to the state unemployment fund. And the reason for that is there's a federal credit. If you pay into your state fund, then the federal government gives you a credit. That's why the federal amount tends to be lower than the state amount. But what you can see here is that this all adds up. 22 0460. Always good to make sure that your journal entry balances. And then obviously this single debit is 220460 as well. So what we have going on with this right here is that the company is recording additional expense. This is an additional cost of paying employees. Okay? It's one that employees typically don't see unless you're the payroll clerk or something like that for the company. But this is an additional cost, and that is going to be payable to the U.S. Treasury, and the state of Michigan in this case. This is a recap of the journal entries that we just recorded. As you might recall, we had one journal entry to record the actual payroll, which included employee withholdings, which are current liabilities. As you can see right here, this is the amount that we credited to federal income tax withheld payable. That is a current liability to the U.S. Treasury, and this was also withheld from employees' paychecks for the state of Michigan. That's going to be due to the state of Michigan. These withholdings right here only come from the employee. So in other words, these are amounts that were withheld from the employee's paycheck, from multiple employees. And then down here, these right here, these are only the employer. Right? Remember I had said if you ever see on your pay stub where your employer is deducting unemployment taxes, report them. This is not acceptable because these are taxes of the employer. Both of these are due to the U.S. Treasury for the federal unemployment and to the state of Michigan in this case for the state unemployment. Now over here, remember how the Social Security and Medicare taxes paid half by the employer, half by the employee? We're seeing, so this is both. This liability right here, here's the employee's portion that we credited with the first journal entry. Here's the employer's portion that we credited when we created the additional expense. And now what you're seeing here is these are the current liabilities. And they're current because these are due within the next few days or weeks, okay, depending on how large your payroll is. These are not long-term liabilities. If you try to make them long-term liabilities, you will see some of the most severe penalties that taxing authorities can impose. And you will get love letters from the IRS, from the state of Michigan that you do not want to receive. So I always advise companies, make sure you stay current on your payroll taxes. That is one of the top things you can do to prevent hassles and severe economic consequences when you're running your business. Let's bring this payroll discussion full circle. You see, I think it's important to note that just as the employees do not receive their full paycheck because of deductions, the employer actually has to pay more than the gross payroll because of payroll taxes. Look at, here's the company summarized records here. Remember that the gross payroll for the employer, in other words, just the earnings of the employees, their salary, their hourly wages, would be just a little bit over $27,000 for this particular company for the period. But remember the employer taxes and deductions that are right here, this $2,200, right? We have to add that, guys, because that is a cost of employing people. You have to pay the Social Security, you have to pay the Medicare, federal unemployment, state unemployment, and there may be other taxes, fees, or obligations depending upon what jurisdictions that you participate in, where you do business and whatnot. But just understand that if you're this employer right here, you don't need to come up with $27,000 to meet payroll. You got to make sure you have a little over $29,000 in the bank. Otherwise, the payroll checks are going to bounce and you're going to start to get love letters from the state and federal agencies.